Hi, everyone. I'm Rick Bensignor, and welcome to this week's In the No Trader Show. We've got a lot to discuss this week because a heck of a lot has gone on in the market since our show last week. Uh, and today's agenda is going to hit upon three different areas in the 30 minutes that we'll share together. The first is to talk about In the No Trader's weekly tactical trader report, what it is and what it isn't, because I get lots of inquiries about it. So we'll get into that in a moment. We'll also spend this week doing something that I do not typically do in this podcast. Because this is really reserved for my institutional clients. But given how much markets have moved in the past week and the influence of the potential additional tariffs that Trump has added on, as well as last week the Fed doing what they did with rates, so much has happened that we're going to take a look at the S&P for key levels, the U.S. 10-year and the U.S. 30-year bonds, the dollar index, one particular currency, the British pound, because it's really kind of on a do or die level as Brexit is still being figured out. Gold, which has skyrocketed. Copper, which has gotten hit harshly on the economic weakness, and then the oil market. And the last thing I want to do is we'll talk about the easiest and fastest way to hedge your long exposure. So that when you have events like this past week and markets start crumbling, there are easy ways to protect your portfolio. So that's what we're going to do today. So let's start off with the first thing, which is let's talk about what is the weekly tactical trader report. And I think the best way I can show you that is just to pull one up. And this is back from late June. I just pulled one that's a little over a month old. So each week, well, first off here, let's start off. The title is Tactical Trader Report. It is not something like the long-term investor, because I get inquiries. People will ask me for a sample, and I'll send them, somewhat of a recent copy, and they'll say, "Oh, it looks short-term." And well, yeah, it's called the Tactical Trader Report. It is for trading the market, is for opportunities that we find in the market that we generally consider short-term. What's short-term? Anywhere from weeks to months. It is not meant to be that I'm buying something and holding it for years or even a year. If we held something a year, and I don't think we have in anything since we started a Tactical Trader Report in April of 2018, it would really be kind of a one-off. It is meant as a shorter-term tactical trading newsletter. And what we do each week is kind of give you a big picture view of what's going on in the markets. In this particular one, I happen to show a little bit about the bond market. I don't usually include charts. I may mention something about the bonds, but I was probably highlighting the sequential 13 potential downside exhaustion level in the TNX chart. And then we talk a little bit about the dollar something. We'll go into breadth figures, look at those. Market, what we'll call market internals. We use a lot of the StockCharts charts for these type things because they're displayed so well. Look at the sector performance versus the S&P. Often we'll show the relative rotation graph also for the same 11 macro sectors of the market with our interpretation of what it's showing. And then we always will do kind of a deep view into the S&P and what we're looking for. So that's kind of standard each week. After that kind of background information that we give, we'll come up with a new trading idea each week, which is always an ETF. We don't do individual stocks. So that's something else you should know about the Tactical Trader Report. It is an ETF newsletter. And I do that purposely because I think that playing individual stocks, there's so much single stock risk that gets involved that an ETF, you might not make the same as if you were long Google or Amazon or some of these names that have been high flyers for years. So you're cushioned against the downside. You're also cushioned against a particular stock flying to the upside. But I think most of the ETFs we trade are very liquid. They're easy to get in and out of, and you don't have the risk associated to owning one stock. And think about too that there are times that a company can report an earnings report, and it'll affect a peer name. So let's say we're along the peer name and they haven't reported, and now all of a sudden our stock gets affected because another similar name has come out with an earnings report that was negative. So I like the diversification that ETFs give us, so that's what we do each week. So you get a new ETF idea each week, and then we also review all open trades. And when we review them, as long as we still have them on and we haven't hit our targets, we will talk about where our targets are. We'll move them. We'll move stops if necessary. And so we do that. So here, for instance, here we were long the XLY ETF, the Consumer Discretionary ETF. And we had put on a 50% position. That's a half position at just shy of 114 with a target of 124. This hit its target a while ago, up at 124 in July, and we exited. We hit our target. I had reason to believe it was not going to substantially move any higher. And so we got out. Now, I know that I actually commented on this on a different website where people put up, other, let's say, technical analysts put up their views. In fact, a former protege of mine, somebody I had hired at Morgan Stanley into the technical analysis group, was buying the breakout above this area, saying that XLY would continue its rally. And I actually commented, this is what makes a market, because we actually just exited the XLY virtually at the same place you're looking to get long. Again, tactical trading. If we buy something near 114 and we kick it out at 124, you've made $10 over 114. That's probably an 8 to 9% move. So you've returned 8 to 9% on your capital in a month. That works for me anytime. Don't need to hit home runs and hold stuff for years. If we can capture a 9% move in a month, that's great. What more do you need? And so on. So that's what we do, and we go through everything. We walk you through every open position we have on. So that's what the Tactical Trader Report is about. So I wanted to make sure that you at least had an understanding of what it was, what it looks like, and what the intent is. And notice even the tagline, positioning individual investors alongside professionals. As you know, the models I use are not generally found in the public domain. These are institutional models that many institutions on the street use to help determine when to buy and when to sell. It is not standard technical analysis. You may see at the bottom of a chart, I may have, let's see if I can find one here. Yeah, you may have a MACD, I may put up a MACD, but I'm not trading or getting into a trade because of MACD. It certainly it can be a supportive view. In this case, we had gotten long platinum, the platinum ETF, kind of off of this trend line hold, off of downside exhaustion from some of these models and hitting propulsion targets. The fact that MACD bounced off of its oversold level, yeah, well, that's another reason for me to have done it, but it's not the main reason. And you're not going to find most institutional traders making major decisions off of a MACD chart, but it's corroborative to me. It's a secondary or tertiary type of signal compared to some of the other models we use. So that's the Tactical Trader Report. Now let's move to our charts and go through these, 8 or so different charts, because that's really the crux of what's going on right now. So let's switch to, we're going to start with the S&P. So since the May bottom, or I'm sorry, it's really the early June low down here at somewhere around 2730, we put in a 3032 upside target. And in getting to that target over the last couple of weeks, we had a sequential sell signal. So here, let's circle this. This signal right here that's now highlighted is a indicator developed by Tom DeMark that, and again, these models are not easy to get your hands on, let alone they're very expensive. But this represents generally a bad time to be a buyer in an uptrend. And if you're aggressive, if it's a bad time to be a buyer in an uptrend, there are certainly people who are aggressive traders who are going to short off of a signal like that. We weren't looking to short, but when it showed up, and we were fairly, at that point, the S&P had gotten up to 1318, and again, we had a 32 target, so we're only 14 S&P points away. We start telling our clients, lighten up. The ultimate high was made just over a week ago. I think it was 2 Fridays ago at 3028. So now 4 points from our target. Same thing. We're telling people, lighten up. There is absolutely no reason to be a buyer up here. And then, of course, the market came off hard this week. Did I know it would fall this quickly? No. I absolutely didn't know we'd fall 200 points, as much as 200 points based on futures that quickly. Nope. But what we did do is tell clients, you don't want to be buying here. Again, we had taken off long exposure in several of our trades as we hit targets, and we avoided this down move by and large. There are a couple things we'll probably get stopped out on. I'll write this report tomorrow night because it gets released late Wednesday nights. But here's what the S&P is now, and this is real time. So as we do this at late morning on Tuesday, we're currently trading at 2858. And a couple of things to notice here is that yesterday we came through the bottom of the cloud, but by the time we closed, we actually closed right on the bottom of the cloud. And the lagging line, this deep blue line, also held against its cloud. So as of now, the S&P is holding a support level that's somewhat important. We're on a 6 countdown, meaning today's the 6th day in a row that the close is less than the close from 4 days prior. Those often come in groups of 9s. So you can see a 9 high back in here. This was 9 consecutive days close above the close from 4 ago. This same type thing that the market pulled off, this 9 count back here, same type thing, 9 in a row, market pulled off. This 9 count did not lead to a high. It continued all the way into the 13 high. And what I'm thinking here now is, given the depth of the sell-off and the fact that for all practical purposes, we hit our target, I'd probably be a seller here. Now, we are holding support, and what's the word you need? Market sentiment has dramatically dropped very quickly, as it should, given the decline. But I'm thinking that probably 2880 to about 2910-ish, give or take, is probably not a bad place to lay out some stock in S&P terms, or sell the S&P. But we are still holding support, but I wouldn't mind, selling into a rally at this point. The key takeaway here is the S&P hit our target. We've sold off. We are still holding some support, but you're going to have overhead resistance. And given the news that came out this week, the tariffs, the potential currency wars that now may take place, and the implications and ramifications from those over coming months, I have no reason to think that we're going to turn around and go make new highs. So I don't mind using a rally here to take some exposure off, again, in general S&P terms, as we get close to, either side of 2,900 again. I don't see what the catalyst is going to be at this point to turn around and make new highs. It just seems highly unlikely. A deal with China is not coming anytime soon. If something positive does happen with China, no doubt the market's going to move higher, but I think that these additional tariffs and the discourse that is growing between the U.S. and China, and actually some other countries in the world that are creating their own trading tariffs and disagreements, makes it hard to really come up with a logical reason why the S&P is just going to turn around and plow to new highs. So we might get in a trading range. Things might get worse. I don't see them getting a heck of a lot better. So that means use some strength to lighten overall exposure, or at the very least, don't go chasing after rallies in stocks. there should be enough opportunity in coming months that the market trades both up and down, that if you happen to miss an up move, you should get another chance on a decline to get into names if you're looking to buy on weakness. So that's the S&P. Let's take a look now at the 10-year chart, and this is yield terms. So this is the TNX, and one of the things I want to just show you before we cut down to the weekly chart is, and here I can even take the cloud away, because notice again, we were talking about that what's called a setup count in DeMark terms. It's 9 consecutive price bars that the close is above the close from 4 bars prior, or 9 consecutive price bars that the close is less than the close from 4 bars prior. When you do that in any time frame, you often have the chance for a near-term exhaustion of trend and a flip. Excuse me. So if we look at a monthly chart of the 10-year, and let's go back to 2012, the 9 count here, and I'll highlight it. This was 9 consecutive months. The closing price at the end of the month in yield terms was less than the close from 4 months prior. You got a 4-month rally after that. And although in 2012, you ended up going lower, you look out a year past there and it's kind of steady. So it indicated the end of the downtrend. At some point, you actually rally 9 months in a row where each one of those closes closed above the close from 4 months prior. And that was the top of the move. We sell down, and in real time, this is counting. So for instance, this close, the bar after the 9th bar, this close, 1, 2, 3, 4. No, let's see, 1, 2, 3, 4. This close in here, so March of 14 would have been a 1 down, meaning a little blue bar would have been underneath this saying it's a close is less than the close from 4 bars back. And 2 and 3 and 4 and 5 and 6. But this close here did not close beneath the close from 4 bars back. And this blue count has to be consecutive bars to get to 9, so it dropped off and the count disappeared. Eventually, though, yields fall, make new all-time lows, and 2 months after making the lowest low, you again have a 9 count, a setup 9 down, suggesting downside exhaustion. Also, just draw a simple trend line against what had been all-time lows. You knew that we had a potential for a long-term double bottom. That certainly got put in place by the rally up that took out the intermediate high. Again, we do a 9 count to the upside a little bit before we peaked last year at 3.25%. And here we are now, and this is the reason I want to bring it up. We're trading at essentially 17.51 in the TNX is the same as saying 1.75%. It trades at 10 times the value of the actual yield in the US 10-year. This is the 9th month down. So pretty hard for me to first tell people to buy bonds or thinks that yields are going to keep moving down with this in place. Now, it doesn't mean it has to stop, but when you look at what the pattern has been for years, you know that when you see this signal, it often represents that you're close to the end of a move. So I am not a buyer of bonds with yields at 1.75, even though there's a lot of people out there, and I don't think they're necessarily wrong, that yields in the U.S. can still go lower. But I tend to be a counter trend player, and as such, I can't recommend to buy bonds and lock in 10-year bonds at 1.75%. Despite the fact that if you look in Europe and other places in the world, they'd be very happy to have 1.75% considering they have negative yields. It actually costs you money in most of the developed nations in Europe to put your money in the bank. That's a whole nother discussion. Now, let me switch this to, let's see what the weekly chart says. So here's the weekly chart. So disregard these ellipses because they're just being transposed from the weekly chart. So we were wrong. We were looking for a bottom to come in place off of this 13 and 9 signal. So we were actually playing, and for no clients, for yields to move higher. And we did get stopped out because we said under 1.95, which I had expected to hold. We get stopped out. So we did. This was a losing trade we put on, but we have very managed risk. and we don't let things go large amounts against us. Especially think about this. If you're buying things typically cheaply, which is what this model does, it tends to buy low and sell high. You don't need to risk much at all, because if you're essentially looking to bottom fish or top pick, you often know fairly quickly if you're wrong. And that's one of the advantages. As hard as it is to bottom fish and pick tops, if you have a methodology behind it, you can often do it well. Here's the 30-year bond. This happens to be the daily chart. And the only reason I bring this up is one of our favorite polls, the one that our sentiment polls that we rely most on, is called DSI, the Daily Sentiment Index. And coming into today, this is a reading that you see maybe once every 5 years. 98% of people polled are bullish the U.S. 10-year. So you're looking at the futures chart of the U.S. 10-year. 98% of people are bullish, and we have an upside exhaustion signal on the daily chart that came in yesterday. Again, it doesn't mean it has to stop, and maybe 98% of the people are correct. But in general terms, that's enough for me to say it's not the time or place to be buying a bond. And I'm willing to be wrong on that, but based on, long time statistics of combining sentiment with exhaustion signals and so on, I think if you buy bonds now, you have lots and lots of risk. So if you want to buy a bond, buy bonds lower. There are support levels that are nearby enough that you can get them better than the price you're going to have today. That's my thought. That's why I brought up the 30 years. It's not something I look at day in, day out, but given the 98% bullish statistic, I thought it worth showing you. Here's the U.S. dollar index. Some people call it the Dixie, the DXY. And we've got conflicting signals here, which is why we went neutral on the dollar. We had upside exhaustion here, which worked well for over a month. The dollar peaked out here and sold down, even broke its uptrend line from the cyclical bottom back in early 2018. But notice the top of the weekly cloud, essentially 3 weeks in a row, was the bottom to the moves. And so you've got one thing saying exhaustion of uptrend, and this says there's support here. So conflicting signals on the weekly chart got us to go neutral. So we are currently neutral to dollar. There is a slight long-term bullish view on the dollar, simply from like Elliott wave type counts. But otherwise, we are, anything near term here, we are neutral for now. And I think there's enough back and forth going on also with world politics that it's easy for me to just be neutral and not try to outguess headlines and tweets, because that's certainly a tough game these days. British pound. I'm going to show you British pound futures right here, not the spot market. So they're quoted very similarly. You're looking at 1.2207, meaning it costs $1.22 of US dollars to buy one British pound. Notice the downside exhaustion signal back here in 2016. A test of that low came months later in 17, and we're getting awfully close now. Late in the latest count, we're on 11 counts, so within 2 weeks we can have another 13. We're still in the context of this 13, which hasn't been stopped out yet. So Boris Johnson, the new prime minister, has a lot of stuff he needs to do pretty darn quickly, because I look at this as kind of a do or die level for the British pound. We can go a little beneath it, but if you go much beneath it, then it's truly in serious trouble, on top of the serious trouble it's already been in for years. So just, again, something that I alert clients to on the institutional side, and something that kind of as a special feature I'm doing today, just because markets have moved so much. Here's gold. This is gold futures. Let me just check. So what you're looking at here, this is the price actually of October gold futures, but the current most traded active futures market right now are December futures, which are trading at 1483, so almost a $12, $13 premium on the active contract now. We have been long this since 1295. We played off of this 9 count in here months ago. And again, we've been long at 1295. We've rolled futures contracts forward. We first got into the April, then rolled it into June, June into August, and now August into December. So our net cost is really closer to about 13, 15 or so. Nonetheless, our target has been 1487 up to around 1830 or so. Yesterday, well, last night, December gold got to 1487. So we are very much close to exiting our gold trade. I'm looking at the last high it made when it collapsed before it further collapsed. That's 1487. I'm looking at where the breakdown was years ago. So this zone in here is our target zone. So there might be some upside to gold. We think it's limited at this point, and I'm more interested in being a seller, not going short, but a seller and taking profits on what I'm long into this zone. And what do we have left? Let's do quickly copper. Here's weekly copper futures. So copper broke the uptrend line from the 2016 low. Notice the 2016 low, happen to say downside exhaustion. Notice 9 count in here, near term bottom. Well, actually more than a near term bottom. 9 count up here, close to the top. 9 count on the trend line that bounced, but then last week we broke the trend line. I connected some lows, so this week's low is kind of holding against here. You're also into the same area that some of these lows in here were. So I'm not going to sell copper down here yet, but you certainly have a lot of trapped longs. There's also, you can see a head and shoulders pattern in here, right? Here's your shoulder, here's a very long head, and now you've got a head and shoulders within the whole right-hand shoulder. So, you know, same type thing, somewhere around 250 copper, give or take, is do or die for that. The last thing I want to do is we're going to actually skip oil, because I want to talk to you about, let's go back to our PowerPoint, and the last bullet point, the easiest and fastest way to hedge your long exposure. So when markets fall apart like they did, as quickly as they did off of, this time, a tweet from the president, if your overall portfolio has any similar type of exposure to the S&P itself, you don't need to panic and start selling out of individual names. You can either, there's 3 things to do quickly. One, if you have a futures account, you short S&P futures. But let's say you don't have a futures account, because most people don't. You can short spiders, SPY, the biggest traded stock or ETF every day in the world is spiders. Or if you don't want to short an instrument because you're not comfortable or even set up to short, use the ETF SH. SH stands for short. It's an ETF that if you buy, it moves inverse to the S&P. So it moves up when the S&P moves down. So if you want to hedge your long exposure, you buy the SH in whatever dollar amounts you want to that represent your portfolio. And you can at least hedge a large portion of your portfolio very quickly. It's very liquid, easy to do, and that's the way that when you need to put on a hedge real quickly, that's the best way to do it. So to contact me, it's rick@inthenotrader.com. Check out our website, inthenotrader.com. There's lots of videos up there. You can find out about subscribing. And we will see you next week. Thanks much for listening.